$100,000, which requires about $145,000 in marketable securities. And the borrowing costs on these lines are based on 1 month LIBOR plus a fixed spread. So you can also use these not just for unforeseen emergency uses, but you can also use these lines of credits for, financing tax payments, bridge financing, buying out a business partner, construction financing. You're really limited by your imagination of how you can actually utilize a pledge asset line of credit. But what makes it an attractive option for a liquidity strategy can be summed up in 3 words, really, and that's cheap, quick, and control. Right? There are no costs to originate the line of credit. There's no cost to maintain the line of credit. And it also provides me quick access to the line. While I'm in the event, I can access the line via check, wire transfer, online transfer, and most importantly, I control when I borrow, how much I borrow, and even how I repay the debt. I can repay the debt interest only, principal and interest. I can let the debt roll from month to month and then pay it all off with one fell swoop. I have total control. But now there are risks, though, associated with these lines of credits. And the main risks revolve around maintenance calls and liquidation. It's always important to remember that these lines are dynamic, meaning the credit line is dynamic itself, and it rises and falls based upon the market value of the collateral you are pledging. So the risk is that if I borrow money on this line of credit and my collateral drops to a level where it can no longer support the outstanding debt, I may be forced via a maintenance call to pay down that debt or add collateral. And if I do not do that, the bank may have to take a step of liquidation and selling securities. So it's always important to remember that it's a dynamic credit line.
As our audience is listening to you share this, that was a great summary. Some may think that this sounds very similar to margin. So can you touch on how the 2 lines of credit differ from each other and why one would prefer one over the other?
Yeah, absolutely. So, at first blush, both PAL and margin, they kind of sound familiar. They both use qualified brokerage assets as collateral for a line of credit, but there are significant differences between the 2 that may lead you to choose one over the other, depending upon what you're using it for and the features of both programs. But really, to understand the difference between the 2, we kind of have to get, in our DeLorean, take it up to 85 miles per hour and go back in time, back to the 1920s. And back then, Patrick, you and I and everybody on this conference call, we could get a loan against anything. I can get a loan against my farm, my Model T, whatever it may be, and I can use those proceeds to buy stock. That worked brilliantly through the 1920s when liquidity was easily available to the public, but eventually liquidity dried up. And that then led to the Great Depression and the stock market crash. These loans went sour, and then it created the run on the banks. So the government took a step back and they said, we don't want to repeat this again. We do not want to have bank loans being used to buy marketable securities. And that gave birth to Regulation T and margin loans. So the first thing to always know, the big difference between a pledge asset line of credit and a margin loan is that a pledge asset line of credit comes from Charles Schwab Bank, right? The margin loan comes from the broker-dealer of Charles Schwab & Co. Now, again, both use qualified assets for the line of credit, but the use of proceeds are significantly different. On the pledge asset line of credit, I can use it for whatever I wish. I could use it for a bridge loan. I could use it to do a construction on a property. I could use it to fund tax payments, emergency expenses, things of that nature, but I can't use it to buy marketable securities. On margin, I absolutely can. I can use it to buy stocks, bonds, mutual funds, whatever I wish. From an eligibility standpoint, and we touched on this earlier, I need to support a minimum line size of $100,000, which requires about $145,000 in taxable assets. On the margin side, I just need as little as $2,000, either in cash or marginable securities. So if I have a smaller taxable account, maybe I have a lot of assets in my IRA, but a smaller taxable account holding, and I'm looking to add something as a liquidity part of my liquidity strategy, I may want to favor a margin loan over a pledge asset line of credit. From a collateral requirement, again, both are using qualified brokerage assets, but there are significant differences there as well. On the pledge asset line of credit, I'm going to get a higher advance rate. The advance rates start at 70% for most of your individual stocks, ETFs, mutual funds, and it goes all the way up to 96% advance for cash and cash-like investments. On the margin side, if I was borrowing on margin to cover a medical expense, or I'm borrowing margin to buy a house, something of that nature, my advance rate is capped at 50%. Mm-hmm. In addition, I do not get any advance rate on cash at all. So that's another issue with the margin side. From a payment perspective, just like all revolving bank line of credits, like your home equity line or your credit card, you do receive a monthly statement for the pledge asset line of credit. You have to the 15th of the following month to pay principal and interest. You can pay interest only, or again, you can let the balance roll from month to month as long as you have available credit. The important aspect of it is that the line of credit is separate from the brokerage, the assets that you're pledging. On the margin side, the margin loan is embedded in your brokerage account. And every single deposit of cash, every dividend, every interest, any cash that hits that account is automatically absorbed. So from a cash flow perspective, from a liquidity concern, trying to develop my liquidity strategy, if I am an investor who relies on this investment account to generate income for me, I may want to favor the pledge asset line of credit over the margin because of that situation where the margin loan automatically absorbs all dividends and interest that hit the account. Right? It gets swept right into it. So that is one significant difference. And then finally we get down to pricing, which 99% of the time everyone always asks, well, what's the pricing on these? The interest rate on the pledge asset line of credit, they're all based on that index of 1 month LIBOR, which currently right now is 0.18% plus a fixed spread. That fixed spread is based on the initial size of the credit line. And it does not matter if I borrow $70,000, $100,000, or the maximum amount, it's all the same rate from $1 all the way up to the max. On margin, the interest rate is based upon the BLR or broker lending rate, and it's based on how much I actually borrow on margin. And as I pay down that outstanding debt, the interest rate actually goes up. So that's another significant difference between the two. And I know this is a lot. This is a lot of information to cover during a call, but again, that's why we're here. So if you ever have a concern about whether should I go with a pledge asset line or should I go with a margin loan as part of my liquidity strategy, talk to us. Talk to your financial consultant, talk to your registered independent advisor. We're here to help you navigate that selection.
Excellent, excellent, excellent. So, those are the questions, Bill, that I have for you. And if it's okay, I wanted to transition to some of the questions we're getting from our audience. We've had a few come in already, and just want to remind everyone, if you want to ask a question to Bill directly, there at the bottom of your screen should be a place for you to go ahead and send that message to us, and we'll try to get to as many as we can here during our segment. So the first question that we have, Bill, comes from Paul in Texas. You touched on this a little bit, but maybe expand, are there any other limitations for the use of proceeds or pledge asset line?
The main issue regarding utilization is you cannot use it to buy marketable securities, but you can definitely use it to fund a business, start a new company, buy real estate, anything that you wish, but the acquisition of stocks, bonds, mutual fund, any publicly traded security.
Thank you. Next question is from Angelica in Massachusetts. Says, can I use a PAL for business expenses? So I think kind of ties to what you just said, but maybe give us an example of some common ways that you've seen small and medium-sized business owners use a pledged asset line for business expenses.
Yeah, absolutely. So the answer to that question is absolutely you can use it for business purposes. Some common usage I've seen is that I've seen clients actually buy out another company, a competitor, using a pledge asset line of credit. They've used it to finance inventory. We've had actually one client in our neck of the woods here in Texas, in Dallas, who used the pledge asset line of credit to buy an entire fleet of vans for their business. So you can use it any number of ways in terms of your business operations. Some other common ways I've seen it is really through commercial financing. A lot of clients have used it for the financing of their property that their business is located in.
Excellent. Thank you. Next question is Linda from Indiana, and she writes, can I use a pledged asset line for a bridge loan for a home purchase?
Yes. And now I would say that if I was to put a percentage on it, I would say roughly about 60% or maybe even greater than that of pledge asset line of credits are used for that type of situation, right? And that's a perfect textbook example of why it's important to have a liquidity strategy already in place. You know, you have your house, you currently own it, maybe you've paid it completely off, and you want to buy the new property, but you have to wait till the current one sells to get your equity out of the home. I mean, one alternative is I could liquidate my investment portfolios, but that could have multiple consequences. I could lose the opportunity to generate income off that portfolio. I could lose growth in that portfolio. And on top of all that, there could be tax consequences with that liquidation. So the pledge asset line of credit is a perfect example of utilizing it for a liquidity need where you can actually use that line of credit to acquire the new property. And then once your existing property sells, you just simply take that proceeds from that sale and then pay down the debt. And that's how you can use it as a bridge loan.
Excellent. Next question, Zach from Utah asks, what does the application approval process look like for the pledge asset line?
So the majority of our self-directed clients can actually originate a pledge asset line of credit online at schwab.com/PAL. And the origination process, the online process, is about 10 to 15 minutes of your time. Upon completing that application, usually the line of credit is open within 3 to 5 days. Another alternative, we can actually do a scheduled phone call between one of our loan officers at Schwab Bank and you, of course, the client. That application call takes about 20 minutes of your time. And then from the time that we complete that application to the time it's approved by our underwriting, it's about 24 hours, 48 hours. Then after approval, we will send to you the actual documents for execution within 48 hours. And you simply sign, return it back to us, and the line of credit is open. So from beginning to end, I would say that the phone application can take about 5 to 7 business days. The online is about 3 business days on average.
And so to follow that up, we have a question from Caleb in Washington who says, so what's the term of how long is the term on that pledge asset line?
Well, that's actually a great question. There is no term. It's an evergreen facility. And that's, again, why it's an attractive option as part of your liquidity strategy. It does not expire. You can keep that line open for as long as you wish. There's not a 5-year, 10-year, or a 20-year term. It's an evergreen facility. If at any time you decide that, you know what, you no longer need it, you can actually close down the line of credit, and there's no fee to close it down either.
Great, thank you. Question from Danielle here in Texas. She writes, who's responsible for the investment decisions related to the pledged securities. So if you're pledging those securities, who's responsible for monitoring, the things that you mentioned before, around the ratio,
So
advance rate, so on and so forth. Yeah, sorry. Go ahead.
no, yeah. So that well, if you're self-directed, really the responsibility is on you, the investor, to manage those assets. You can still buy and sell securities within that collateral account. I can buy individual stocks, ETF, mutual funds, individual corporate bonds, treasuries, CDs. But the one restriction is that there's actually two restrictions. One is I can't have margin established on that account because obviously it will be double collateralized, right? It'll be pledged to a bank line of credit. Any marginal loan, it will be in effect double collateralized. So you can never have margin established against the account. And the other restriction is that you cannot do any option trading within that account. So you can't do any of the sophisticated trading strategies we probably discussed earlier today within that collateral account. But for everything else in terms of buying and selling individual stocks, mutual funds, ETFs, U.S. treasuries, corporate bonds, things of that nature, it's perfectly fine. Now, this is also a benefit of working with a either Schwab Private Client or an independent advisor. They can manage the assets for you in conjunction with your liabilities, and that's part of our role, right? We manage both sides of the balance sheet for you. So if you're self-directed, the onus is really on you, the investor. If you're working with Schwab Private Client or if you're working with one of our independent advisors, that is a responsibility that they take on in terms of managing for you.
And so let me ask a follow-up question. It says you were sharing that. So, knowing our audience too, where option trading may be important to them. And as you mentioned, that would be a no-go for a pledged asset account. What have you seen for those individuals and how they kind of separate to be able to get the liquidity they need in the pledged asset line, but also continue to be able to do their option trading, at their Schwab account? What's best practice there, Bill?
Sure. So we obviously we deal with a number of different types of investors here at Schwab, right? We have all different types of investors, and because of that, we actually open up a separate collateral account for you, and that's the account that you're holding the taxable securities that are pledged to the line of credit. So what a lot of clients do is they may actually pledge their long-term assets, or maybe even a concentrated position. Maybe they have a whole lot of Apple stock with large unrealized gains. They may use that hold it in their collateral account, and they still have their regular brokerage account. They do their option tradings and so forth, vice versa. But that's why we actually create, when we go through the process of opening a pledge asset line of credit, we actually open up a separate collateral account that's in your name, right? That's connected to the line of credit. Think of it as almost like a bucket that holds what I'm pledging as collateral. And in fact, I can actually swap securities in and out of there. Maybe I want to take that Apple stock out of the collateral account and swap in Cisco or another position, right? Because I want to do some option trading on Apple. So that provides you that flexibility to truly control exactly what you're pledging as collateral within that account.
Yeah, I think that's a great key point because, again, I think probably our common misconception is thinking of margin. It's, if you've only got one brokerage and trading account at Schwab, it's that or else. And what you're saying is it's actually not the case. The client has some control and flexibility, and in this case, would open up a second account and decide, as long as the securities are eligible, what you're saying, what goes in the pledged asset line account versus what they want to keep in the trading account. So,
and there's even another benefit of it. One other common question is that a lot of people wonder, is it just can I have one collateral account or can I have multiple? Because maybe I'm using multiple different strategies. Maybe in one of my accounts I have it as a fixed income portfolio,
right.
Another account have it as my equity portfolio, and another account maybe has my option trading. And you can actually have multiple accounts pledged to one line of credit. So if I'm running multiple different strategies in each one, maybe using multiple different even asset managers, right, and 3 different accounts, I can still keep them all segregated in 3 different collateral accounts, all pledged to one large pledge asset line of credit. So that's another unique feature of it. You don't have to have just one collateral account. You can have multiple collateral accounts.
Thank you for that. I learned something new. Didn't actually know that myself. All right, so let me get back to our questions. I want to make sure we get to as many as we can. And again, if you have one for Bill, please go ahead and ask that. We'll definitely try to get to it. So this one comes from Karen in Tennessee. She writes, how can I determine what assets may be eligible for the pledged asset line?
So actually, that's a great question. I'm going to share our website here. And again, this is, by the way, if anyone has any questions about Charles Schwab Banking Services we offer, this is all online at schwab.com/bank. But if we were to go down here to pledge asset line of credit, and you can actually go to this website online through schwab.com/PAL, P-A-L. If you scroll all the way down here, it goes over a little bit over the program, as well as that we have a fact sheet that's available to you, our interest rates based upon the initial line size of the credit line. But down at the bottom, there's an advance rate lookup. And if I click on this, I can actually enter in a security. So for example, we're using WebEx, which is owned by Cisco. So let's take a look at let's look at Cisco. They have a 70% advance, meaning for every $1 in Cisco shares that I have, I'm getting 70 cents on the dollar in borrowing capacity. So this is one way you can, if you wanted to, you can actually go position by position here on the website and look up your advance rates. Another option is simply pick up the phone and give a call to your financial consultant, your local branch office. They'll be more than happy to connect you to a regional bank manager, and we can provide an estimate for you of how large the facility would be, and go position by position and tell you the individual advance rates for each position that you hold.
Excellent. Thank you for sharing that. Great resource there. And I think we'll probably come back to that too before we wrap. Just remind everyone where they can get additional information. So I want to get to a question from Tech in Washington. What's the main difference between the home equity line of credit, the HELOC, and the pledge asset line, PAL? You talked about the margin in PAL quite a bit, and I think specifically Tech wants to know what's the interest rate difference, and then ask, is there's a PDF of this? No, we don't have a PDF, but you mentioned the website as a good resource. Would you, so maybe follow up with that, confirming that's a good resource for Tech going forward.
Yeah, so every individual situation is different, but in general, so to kind of break it down, the difference between the two, the origination process is dramatically different between a home equity line of credit and a pledge asset line of credit. Remember, part of Dodd-Frank, we have to abide by the ability to repay laws and all the documentation required with anything that we're using a residential property as collateral. So with a home equity line of credit, it does take time to originate. It can take 30 days. An appraisal is required. I do have to provide full documentation in terms of tax returns, bank account statements, and so forth. And the other thing to keep in mind is that your credit line is static, right? So if I establish a home equity line of credit for $100,000, if my house goes up in value, it's still $100,000. It's not dynamic, does not automatically go up. The interest rate on a home equity line of credits, they're all based on an index, and that index is called prime rate. And we've heard that a lot. It's the same index that is used for credit cards and other consumer debts, and also a lot of small business loans are based on prime rate. Prime rate right now is 3.25%, and how the banks calculate prime rate, how they come up with that number of 3.25, it's a very, very sophisticated mathematical formula where we basically just take 3% plus Fed funds rate. That's it. So right now it's 3.25%. On the pledge asset line of credit, and this kind of illustrates the difference in cost, they use an index of 1 month LIBOR. 1 month LIBOR right now is 0.18%. So right off the bat there, the difference between the indexes alone, it's over 300 basis point difference, a 3% difference in interest rates. So that is one benefit. 1 month LIBOR moves with the Fed funds rate as well. So as the Fed increases interest rates, both indexes go up. As the Fed decreases interest rates, both interest rates go down. The pledge asset line of credit, my credit line's dynamic. It goes up and down based upon the value of securities. Another benefit of it is the origination process, right? I don't have to provide tax returns, personal financial statements, bank statements, an appraisal, and so on, so on, so on. I can have it established fairly quickly, basically within a week to maybe a week and a half. I can have one set up and ready to go. And then it comes to accessing that line. With home equity line of credits, you typically you can access them using a check. With the pledge asset line of credit, if I have an investor checking account, I can actually transfer directly from that line of credit right into my investor checking account, and I can actually pay for a contractor, do whatever I need to do via my debit card, my checks that have connected to my investor checking account. I can do as many wire transfers off the pledge asset line of credit, and every wire transfer that I do is completely complimentary. So it really depends on your total financial picture, what's your goals and objectives, where you are holistically. That's how you kind of determine which approach is the best for you. But both of them are, at the end of the day, an excellent choice as part of your overall liquidity strategy of having one proactively open.
Great, thank you. We have a question from Mary in California. What effect does the PAL have on your credit score, if at all?
So we do, upon origination, we do pull your credit report from one of the credit bureaus. Equifax is to get your credit score and verify your information. So there is one hard pull. But after that, after it's established, and this is one of the benefits of the pledge asset line of credit as a liquidity solution, we do not report the line of credit to any of the credit bureaus. Nobody will know of its existence other than you, Charles Schwab Bank, and your financial consultant. It is a true private bank type facility. It's completely private. So we don't report it on an ongoing basis to any credit bureaus. If you were to have, let's say, a pledge asset line of credit established that has a current credit limit of $250,000, someone's not going to be able to pull your credit report and see that you have this facility in place. They're not going to see your payment activity. It is 100% private.
Excellent. Question from Kyle in Arizona. You showed a minute ago the advance rate for position. So what's the basis for perhaps those rates changing? What would cause them to change, if at all? And is there a range or a maximum minimum, of a change?
So in terms of in equities, right, and that's where you see the most fluctuations. If it's a blue chip company, has a great market capitalization of a $2 billion plus, has a healthy trading volume, you're looking at a 70% advance. But if there are some outside factors, let's say it's thinly traded, or it's a small cap. If it's below $1 million, the advance rate may be reduced to 50%, or it could be actually zero. There are some situations where, especially for companies that are, let's say, trading below $3 a share, or have a small cap, that we do not provide any advance on. And the reason for that is when you get to that size of a company in terms of market cap and trading activity, the slightest movement can create a maintenance call. So we do not provide advances on those types of equities that are trading at that level. So we provide 70% advance on all of your your Dow Jones type, your well-known companies, your Facebook, your Apple, your Cisco, even your other less-known companies like PPG, IBM, so on and so forth. Those all get 70% advance. It's the small caps that you have to be mindful of, and you definitely want to check before proceeding.
Excellent. Well, Bill, this was great. I feel like I'm using the word excellent a lot because it has been. I think it's been very informative. I think the questions have been very engaging. I think your answers have been spot on and like I said, very helpful. And I think a topic that we covered today is important that we may not be thinking about as a priority, but especially, and I think in this current environment and what we just went through, I think you and I are talking that this was a topic we wanted to get out there to our audience, to our clients of Charles Schwab, of the liquidity strategy. So I'd like to just have you once again share with us where our listeners can go if they want to learn more about some of the lending solutions available to them through Schwab Bank.
Absolutely. And again, if you want any additional information, it's all available online at schwab.com/bank. And when you get to our main landing page, you'll see right down here we have our high yield investor checking account, our home lending page where you can actually look at today's rates, both for our home equity line of credit options as well as for our mortgage options, which include principal and interest-only ARMs and your traditional fixed rate mortgages, and of course, the Schwab Bank Pledge Asset Line of Credit. It's all here on one site.
Perfect. So those who have been watching and listening today, we thank you for joining us, and we hope you join us again on Modern Wealth Strategies. We'll be live on Friday.